ARM Holdings just reported its strongest first quarter on record. Revenue reached $1.29 billion, up 22% from a year earlier, with both royalty and licensing income setting new highs. Non-GAAP earnings per share came in at 45 cents, beating consensus by more than 12%. And yet, in the day after the report, ARM's share price fell 8.14%, extending a 30-day decline of 22%. A company eating every headline number is being sold, not bought. Underneath the headline, two forces are pulling in opposite directions. Data center royalty revenue more than doubled year over year, driven by adoption of ARM's Neoverse architecture inside hyperscale cloud chips. Demand for the new ARM AGI CPU platform now exceeds $2 billion, according to CEO Rene Haas. But management also lowered its full-year smartphone royalty growth guidance from around 20% to the high teens, citing higher memory costs squeezing handset makers at every price tier, not just the low end. So the drop is not a verdict on the quarter itself. It is a verdict on how much of ARM's future the stock already assumes. Analysts note the most followed valuation narrative treats the recent pullback as opportunity, setting a fair value near $430 against a last close of $260. But an alternative discounted cash flow model, built on the same disclosed numbers, puts fair value closer to just $89 a share. The gap between those two numbers is the real story. It is a disagreement not about whether ARM's business is strong, but about how many years of dominant, high-margin growth the market should pay for today.
The clearest test of that disagreement sits inside ARM's newest business line. The first generation of its AGI CPU chips is expected to carry gross margins in the high 30 to low 40% range, CFO Jason Child confirmed on the earnings call, well below the company's long-term target of 50%. Supply chain constraints across wafers, substrates, test capacity, and memory are limiting how quickly that first generation can ship, even as demand for it has grown to more than $2 billion in under 3 months. Wall Street itself is split on how to price that gap between demand and margin. Wells Fargo maintained a buy with a $280 target. Barclays and Citi both reiterated buy ratings, with Barclays setting a target as high as $360. But Benchmark Co. has held a hold rating since mid-July, and the same period saw a rise in insider selling, including ARM's chief administrative officer selling over 11,000 shares for more than $4.4 million. Bullish analysts are pricing the AGI CPU's long-run margin expansion. The skeptics are pricing its near-term execution risk. Management gave no new margin promise on this call. CFO Child was explicit that the 50% long-term target and the multi-year path to it are unchanged from what was said 3 months ago. What has changed is the confidence in securing enough supply to serve the doubled demand. That leaves the AGI CPU story exactly where it was, just larger, still a bet on execution rather than a resolved outcome. ARM has said a fuller revenue and margin update will come at the end of the third fiscal quarter, which is the next point where this gap between demand and sub-40% margins gets tested against reality.
That question, whether investors are reassessing ARM's business or simply resetting the price they're willing to pay for its story, is the one this earnings reaction actually raises. The operating numbers this quarter do not support a thesis that ARM's core business weakened. Royalty revenue, licensing revenue, operating margin, and free cash flow all improved from a year earlier, and the smartphone slowdown is a demand-side headwind common across the whole handset supply chain, not something specific to ARM's technology losing ground. What has changed is how much patience the market extends to a valuation built almost entirely on a multi-year forecast. The nearly 5-fold gap between the $89 cash flow-based estimate and the $430 growth narrative estimate, both drawn from the same disclosed figures, shows just how sensitive ARM's price is to assumptions about years the company has not yet reached. An 8% single-day drop on record numbers is what that sensitivity looks like in practice. Any softening in guidance, even one confined to smartphones, forces a repricing of a story that was never fully backed by current cash flow. The strongest supported reading is this. ARM's underlying business, led by data center royalties and AGI CPU demand, is expanding faster than a year ago, and the smartphone softness is a known, bounded headwind rather than a new structural problem. What remains genuinely unresolved is whether the current price already assumes more of that future than the company's disclosed margin trajectory can yet justify. The end of the third fiscal quarter, when ARM has said it will give a fuller revenue and margin update for the AGI CPU line, is the next point where that assumption gets tested against actual numbers rather than